As long as the crises are forestalled, then maybe they'll keep rates higher. But as soon as there's a problem, they have shown, yeah, just throw all that out the window. They'll cut, they'll start their emergency programs and all the rest. And so, again, show me it's different this time. I don't believe it. And I think those folks will all be proven wrong.
This is Kaiser Johnson with Liberty and Finance, and this is our weekly special for November 20th through November 27th, 2023, while supplies last. First this week, we feature 1/10 ounce gold eagles at just $32 over melt. Next, the Royal Canadian Mint's half-ounce silver polar bears are available at just $2.35 over melt per coin. Both our specials this week are IRA eligible. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Craig Hemke from TF Metals Report. Craig, thank you so much for joining us today.
Hey, Elijah, nice to see you. Happy Thanksgiving week.
Yeah, happy Thanksgiving to you as well. It's great to visit this week with you. I did want to discuss kind of, I guess, maybe a year-end wrap of what we've seen in the precious metal markets. I know you were expecting kind of based on, we had an interview back in January, and the first half of the year was really lockstep of exactly what you were expecting. Your perspective on kind of the second half of the year now, where we are and what we'll be heading into in 2024.
You know, as you were speaking, Elijah, I was thinking about how this year is kind of a microcosm of what it's been like to be a gold investor for the last 10 or 12 years. I mean, my site, it's just turned 13. So for all the parents out there, we're a teenager, precocious, maybe a little bit, too addicted to our phones. But nevertheless, over these 13 years, you know, I've always written about the end of the great Keynesian experiment, you know, this exponential explosion of debt and debt service costs and how that just, you know, leads to a rapid, and we're getting there now, finally, 12 years later, right? I mean, the debt service line item on the US budget is now $1 trillion a year. And so we're just finally getting there. So I've been right the whole time about this. You just don't know how long it's going to take. And so when I say this year's kind of a microcosm of that, that's kind of the same thing. I mean, everything I wrote about back in January, I still believe in, and I still was, I think, right. It's just like 6 months behind schedule. It's just taken a little longer. And I don't mean that as an excuse. I'm surprised myself that the data kind of has held firm, you know, the data that the Fed looks at. And some of it actually seemed to improve a little bit over the summer. You know, when we got at the FOMC meeting in June, even the FOMC members were talking about rate cuts maybe as soon as December and 4 rate cuts in 2024. That's what the Fed was projecting. 5 more in 2025. And at that point, we were right on track. I thought, oh, yeah, okay, perfect. This is exactly what I've been suspecting would happen. The economy would slow down. We'd start getting rate cuts. Gold would move above, break out of its range. Excuse me, tack on 10%, which things often do when they break out. And then instead, all of a sudden, you know, the data seems to get a little bit better. And by the September FOMC meeting, not only are any hints of rate cuts gone for the remainder of this year, we start talking about rate hikes, and future rate cuts for next year get cut from 4 to 2. And, you know, what does gold do? It goes down instead. Now it has since rallied as things have gotten softer again. And even the market, Fed funds futures, is starting to pull rate cuts forward again and starting to talk about 3 or 4 for next year. So now all of a sudden we're right back to where we were in June. It's just like we lost 5 or 6 years or 5 or 6 months that we're not going to get back, which again is what a lot of people feel like have been holding gold for the last 10 years. So I still expect the economy to continue to weaken. I expect the Fed to respond to that because that's what they've done consistently over the last 15 years since the paradigm changed, you know, toward QE and zero bound interest rates and the like. And I think that is shown in price with a rally in the first half of the year that does what I thought the back half of this year would do. Get above 2,100, tack on 10%, and should be a good time for everybody.
That is what I'm hearing, is that really gold and silver are setting up for a new run. We are seeing miners extremely depressed right now. But it sounds like what you're saying is really the next 6 months should be pretty good for the metals.
Well, and again, I think that's the case. We've rallied really, really well over the last month. Some of it, the Israel-Gaza thing, but most of it is this change of financial conditions, easing of financial conditions with the dollar coming down, the stock market going up, bonds rallying. And that has bled over to this almost 10% rally in gold. I mean, gold now is, was about what, 1830 back at late September, early October, and now it's 1970 or whatever it is, and up on the year. I mean, we began the year at 1830. So we're back to being a typical year in gold, about 9 to 10% return. And again, you mentioned the shares too. The issue that it's struggling with, at least here in the back part of November, we saw, at least to my eye, a deliberate attempt to keep gold price down back on Friday when options were expiring on the GLD and the SLV. I'm writing about that today for Sprott Money. And pretty soon, next week, we get the front month December contracts. Those have volume and open interest all year long, and they will go off the board, and the options will expire next week. So we're probably kind of swimming against that for the next week. But once we get into December, the next jobs report will probably be weak. Seasonally, all the seasonal and birth death adjustments for November and December are weak and small. And so the next jobs report is probably going to be weak. That'll probably allow the Fed to be kind of less hawkish, a little dovish by the time they meet again in the second week of December. So I think the stage is set for a year-end rally. You mentioned the miners. Here we are again, another year where the mining shares are underperforming everything else. And so we are going to get a spate of tax loss selling. Usually that goes into about the 15th or 18th of December. People think it goes later in the year, but a lot of people want to put that stuff behind them before Christmas, not jack around. I'd get it over with. And so tax loss selling, when it happens, and like it will happen, it's usually done by about the middle of the month. So the shares will probably remain under pressure. But once you get a little bit of breakout there, the GDX gets above 30, stage be set for a rally there too.
You mentioned how a big thing that has been impacting the economy and also the markets is the Fed holding rates higher for longer and not really looking to cut rates anytime soon. A lot of people are concerned about that there's a lag effect, right, of the impact of higher rates. Your take on that? I mean, do you see further things breaking in the economy? We saw the banking crisis back at the beginning of this year, but it's been pretty calm with respect to the financial system. But rates are, the highest they've been in many, many years.
Obviously that muddies the picture, right? And that lagging effect is the thing that even the Fed goons, as I call them themselves, when they grab a microphone on Bloomberg or CNBC, I saw that last week a lot. Well, we don't know. We're going to have to wait and see. This kind of stuff, like they pay you, 6 figures a year. I could do that. I mean, for crying out loud, because they don't know. One of the things that I think kind of deceived them a little bit is the U.S. housing market. And housing prices have stayed up and have continued to rise despite the fact that mortgage rates are now, a couple of years. My mortgage in the house that I'm sitting in right now is 2 7/8%. Why in the world would I sell my house, right? I saw a stat last week that said 40% of U.S. homes don't even have a mortgage. They were bought with cash, either by the owner or by, some hedge fund, BlackRock or something. But anyway, so the impact of higher mortgage rates has really been muted. And because there are no houses on the market, why would I sell my house if I got a 3%? Well, I'm not letting the bank off the hook, and I'm sure I'm not going to sell my house to go buy another house at 8%. So because there's a lack of supply of current homes, existing homes keep getting built. And that on the surface, well, look how strong the housing market is. They're still building homes, even at 8%. Without scratching under the surface, and realizing that builders are kind of coming up with creative ways to help new first home buyers manage that 8%. So I think there's, besides just the lagging effects in general, I think there's stuff that is kind of masking and clouding and making that picture more opaque. That's 3 ways of saying the same thing, in case you're counting. And so anyway, a lot of this might accumulate really quickly in the first half of the year and catch them by surprise. The other thing I'd add, Elijah, there are a lot of folks out there and people that I think are way smarter than I am, that think the Fed is keeping rates high and they are going to keep, and they may until something breaks. I live in a state adjacent to Missouri, right? You're going to have to show me. I believe that the paradigm changed in 2008. Bernanke came out and said, "Oh, this isn't, first QE program in 2009. This isn't QE. We're not monetizing yet." Yeah, you were. Well, it's a one-off. No, it hasn't. It's proven not to be a one-off. Okay, somebody's got to buy the $8 trillion of treasuries that are coming due and haven't be rolled over with new issuance in the next 6 months. Okay. I believe the Fed has shown since 2009 that that's what they will do as soon as the crisis hits. As long as the crises are forestalled, then maybe they'll keep rates higher. But as soon as there's a problem, they have shown, just throw all that out the window. They'll cut, they'll start their emergency programs and all the rest. And so, again, show me it's different this time. I don't believe it. And I think those folks will all be proven wrong.
And it seems like that would be the best, the best environment for gold is that stagflationary environment that we've talked about so much before. Because if the Fed is going to be forced to cut rates and ease again, but we are still seeing a slowing or breaking economy, you have to play the cards you're dealt, right? It seems like the best thing in that environment would be the precious metals.
And stocks. What the heck? There's a lot of talk over the last 6 weeks or so. What's going on? There's a long-term relationship between real interest rates and gold. And you've probably seen the charts. People listening to us have seen the charts. They move in tandem, and all of a sudden they go like this. And by that chart, with where real interest rates are, at least in terms of inflation expectations versus the nominal rate, you would think gold would be like $1,200. It's not. It's almost $2,000. What's going on? Well, there's a number of reasons for that. But one of them is it's not fear in terms of, oh my gosh, I'm going to lose money. It's fear of missing out for that next rally when the Fed turns the spigots back on. I think it's absolutely the same is true in the stock market. Back when I got my Series 7 license 33 years ago, I didn't have all these wrinkles. But back then, there was like a fundamental relationship between, prices and earnings, and you're entering a recession, so earnings are going to be falling. So therefore, if you want to keep the same PE ratio, the price is going to come down too. That's all out the window these days, brother. And I think besides the fact it's only 7 stocks that drive the S&P these days, stock prices and the indices remain elevated by fear of missing out, not fear that, there's a 30% crash and, my 401k is going to become a 201k. Remember that old joke? It's instead, I want to make sure I'm long for when the Fed starts cutting again. And unless you switch that back to just straight up fear, it's going to be a pretty good time to, just be into general stock market too, I'd suppose. It's kind of that crack up boom kind of thing that we've talked about for decades. Same kind of phenomenon, I guess.
And when we see a move in the metals, we often see a bigger move in silver. And it's interesting. I guess one possible reason for that is it's a lot easier to get into an investment when it's, $20, $30 as opposed to about $2,000. And, clients call up sometimes and they only have a certain amount to invest. It's like, well, it's a lot easier to get into silver with that amount of funds. Your perspective on that going forward, I know one of the things that we saw, interestingly enough, was India. And there's a lot of demand for precious metals from India, and also seasonally as well. But we saw a record month for imports of silver, which kind of plays into that same idea that right now it's a lot easier to acquire silver than gold. Your take on that and how that might play out moving forward?
See if I can cohesively tie all this together. I think I've had enough coffee that I can do it, Elijah. There's a reason why the gold price is seasonally strong in December. And one of those reasons is the seasonality of Indian imports of gold, because the wedding season in India is in the summertime. And so imports typically surge in December and into January in preparation for that. Okay, now further, what we've also seen is when gold prices are high, there's a shift often. Just like anybody else, you shift into silver instead because it's more affordable. So the fact that Indian silver imports are rising and surging here in November and then into December of this year, that makes total sense, right? Now, bringing that back then down to just gold and silver prices going forward. Think of that Indian thing as like like an Indian physical metal gold silver ratio, right? As gold prices goes up, it makes silver look more attractive to Indian buyers. Well, a lot of people trade that here in the West. They look at that gold silver ratio and go, when it comes down, maybe I get more gold, and when it goes up, I get more silver, that sort of thing. As this then relates to the silver price, it drives me crazy, drives everybody crazy, right? However, I'm pretty confident that the gold price is going to break out for a number of reasons, not just the Fed, this ongoing central bank demand, falling supplies of gold around the world, all these different things. I think we're going to finally break out of the range next year, get above 2,100. It's been my experience in all of my years of stocks and commodities. Anything that breaks out to a new all-time high generally rallies just on average 10%, not hard and fast 10%. Some go 6, some go 14, whatever, but on average about 10, just on the positive momentum of the whole thing. And you get some headlines. And you can imagine, Elijah, gold above 2,000 at the end of the year, or above 2,100 in January. Oh, gold, new all-time highs. And everybody starts calling their stockbroker, hey, I got to get some of this gold. It's a new all-time highs. What's going on? And so it kind of feeds on itself. Let's just say my target for this year is met sometime next year in the first half of the year at 2,300 for gold. Let's go back to that gold-silver ratio. Is the gold-silver ratio going to go to 100 because gold's at 2,300 and silver's at 23? Nah, probably not. So as frustrating as it is to watch silver, if I'm right about gold, silver is eventually going to play along. And the same thing's going to happen there. Silver is going to get above 28 and 29 and finally be breaking out. And people are going to start getting interested. And the funds are going to come back to trading the metal on the COMEX, which they've avoided now for a couple of years. And you're going to start having a 3 handle. And all of a sudden it's going to do its own 10, 15%. And then that'll impact the miners too. So I hope I made that a kind of where all that kind of stuff could tie together. At the end of the day, like I said, where Indian gold and silver buyers are kind of playing their own gold silver ratio, I think silver investors, anybody looking to buy physical silver, calling up Andy at Miles Franklin and having him get you some, should look at that and think, okay, if we're right about gold, then now's probably a pretty good time to buy silver too.
Definitely will be very interesting to see what happens coming in 2024 for the precious metal markets. If people are interested in continuing to track this with you, where can they find you, Craig?
Right there, like I said, 13 years. Holy smokes. But I talk a lot about the value of the community, and that's no doubt great at TF Metals Report. You get that for $15 a month. Like a magazine or a streaming subscription. Slightly more than that. I think you're going to learn a lot more at TF Metals Report, not only from my analysis, but from everybody else there. At this moment in time, with where we are in terms of monetary policy and economically, if you took $150 and bought yourself a year of access to TF Metals Report, I think that's probably a pretty good investment. I'll just leave it at that. Check us out, tfmetalsreport.com.
Fantastic. Craig, once again, thank you so much for your time today, and God bless and happy Thanksgiving.
You too, my friend. Always good to see you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.